Hey guys, Josh here, and today I'm going to talk to you about the wheel strategy, and that involves selling covered calls. And I'm going to start with a trade that I made today with several different accounts. I typically, when I make a trade, I will make it across multiple accounts. I have different accounts for well, because I have different account types, and they all have different tax strategies and things like that. Not really important, but some people might have that question as I go through some of these accounts, like, why do you have six different accounts? Um, anyway, there's different reasons for that, but that has nothing to do with the strategy. So, one of my favorite stocks to trade is TQQQ. I'm going to go ahead and share my screen here, and I'm going to show you some of this. So I'm going to share, let's see, share my whole screen. That should bring it up now. Okay, so and here's a spreadsheet that I use to track all of this. Now I've taken all of the custom information out of, like, all my account numbers and stuff out of it for security reasons. But basically, here's my six accounts. Now the stock that I like to trade the most is TQQQ. I'll put that here, TQQQ. For those of you that don't know, there is a stock out there called QQQ. Okay, that is the Nasdaq. Okay, it's the top 100 stocks in the Nasdaq. You can go out and buy the stock QQQ, and it's basically going to follow whatever NASDAQ does. So if the NASDAQ is up 1% for the day, QQQ is going to be up 1%. If NASDAQ is down 1%, then QQQ will be down 1%. So TQQQ is the same thing, except that it is triple leverage. So triple leverage just means that it's going to perform three times whatever the NASDAQ does. It's the same stock as QQQ, except that T there means that it is triple leverage. So on a positive note, it means that if the NASDAQ is up 1% for the day, then the TQQQ is going to be up 3% for the day. Likewise, on the downside, if QQQ is down, or the NASDAQ is down 1% for the day, TQQQ will be down 3% for the day. Now, I'm a believer in long, buy and hold, especially for index stocks. So that's why I like TQQQ. That way, if over the next year, if the Nasdaq does 10%, then my TQQQ is going to do 30%, and that's why I do it. That's why I believe in buy and hold for the long term on this one. And on top of the appreciation of the stock, I also use the wheel strategy, and I sell covered calls against it to collect premium. And I get to keep that money and use it to buy more shares, regardless of whether or not the stock goes up or down. And I'm going to explain a little bit how that works. So here are the six different accounts that I have. I've just prepared a spreadsheet, and I'm going to walk you guys through this. So here is six different accounts that I own. Here are the number of shares that I own only on TQQQ for those accounts. Let me put a comma separator in there. So the first account, I don't have any. I have different stocks in that one, but on these five accounts, I have TQQQ, and that's how many shares I own. So I altogether, there are actually, I think, yeah, include all those accounts. Okay, so altogether, 7,600 shares, and that actually means that you can sell. Normally, it would mean you could, if you had 7,600 shares in one account. When you sell covered calls, all options contracts represent 100 shares of stock. So if you own 7,600 shares, take 100, divide that by 100, that means that you could sell 76 contracts, because you've got 7,600 shares. You divide that by one options contract, which is 100 shares. So essentially 7,600 divided by 100, because every options contract is 100 shares of stock. 7,600 shares means you can sell 76 contracts. Now, mathematically, it doesn't work out that way, because I've got different number of shares in each account. So for this account right here, I have 162 shares. Well, everything rounds down to the nearest 100, so I can only sell one contract out of those 162 shares. This account, I have exactly 2,000 shares, so I can sell 20 contracts. This account here, I have 610 shares, so I can only sell six contracts. This account here, I have 3,640 shares. I can only sell 36 contracts. this account here, I have 1,215 shares. I can sell 12 contracts. So you add all that up here, actually equals 75. I think I just left out that last one. Yeah. Let me adjust this real quick. See, 9. All right. So I can sell, even though I have 7,600 shares, I can actually only sell 75 contracts because it's because of the rounding down for each account. Okay. So now my cost basis on all these actually bought, I part of the wheel strategy, which I will cover in more detail here as we go through. It's sort of a cycle. It kind of goes in a loop where you start out by buying the stock, then you sell covered calls, and then when that option expires, you're either going to finish in the money or out of the money, which means if it closes below your price, you keep all your shares, you keep all the premium, and you rinse and repeat. You do the exact same thing the following week. The other option, which is option B, is the stock closes above your strike price on whatever you sold that covered call at. And again, if this is confusing or if I'm moving too fast on this, don't worry. I'm going to cover all this in detail. I'm just kind of explaining the steps, and then I'm going to go through in more detail. But when you sell covered calls, there's really only two possible outcomes. You pick your strike price. In this case, I bought the stock at $38 a share. Okay, just about maybe 2 weeks ago. Okay, now I'm going to sell a call on this, which means I'm going to get paid a premium for doing that. The strike price that I chose was $41.50. Okay. As you can see, actually, yeah, I'll put over here in a strike price column. I keep track of this in the spreadsheet. Again, I'm going to cover all this in more detail. So if you're feeling a little bit lost or a little bit confused right now, it's okay. I'm just kind of laying a foundation. I'm laying the groundwork, but I'm going to dive into each one of these. I'm going to explain each of these columns and kind of walk you through it. So for a starting point, the first thing you have to do in order to use the wheel strategy is you have to own the stock. Okay. So right here, I've already covered here. I own 7,600 shares across multiple accounts, but because it rounds down, right, 162 shares, I can't sell 1.62 contracts. I can only sell one contract. So I can't sell any covered calls on those extra 62 shares that I own. I just can't. For an options contract, I just can't do anything with those. Again, I've got 10 extra shares here, 40 extra shares here, 15 extra shares there. I can't do anything with any of those as far as an option is concerned. So they all round down. So if you round down on all these, I can sell a total of 75 contracts. And again, I'm going to dive into this a little bit deeper as we go. So as a basis, what I did is I essentially, I bought these 7,600 shares for right around $38 per share. Okay. So, and if I multiply that out, let's just move this over here and just say equal that number of shares times $38 a share. So my outlay of cash was $289,826. Okay. So that's how much it cost me to buy all of that stock. Okay. Now I'm going, that's step one. Okay. So I'm going to write that down as we go here. Step one, buy the stock. Okay. Step two, sell a call. Okay. So, and there's two steps to that selling a call. You pick your strike price and pick your expiration date. Okay. And I've got both of those in here in my spreadsheet. They're kind of have to look around for them, but I know where they are because I created the spreadsheet. So the strike price that I chose was $41.50. Okay. So here I'm going to go step by step. I'm going to go real slow with this. So I bought the stock at $38 a share. Okay. I'm going to sell calls at $41.50. Okay. What that means is when I choose my expiration date, and here it is right here, I actually chose September 1st, which is this Friday, 2 days from now. When the market closes on Friday, okay, there's only two possible outcomes. Okay. TQQQ is either going to close below $41.50, meaning it's going to close at $41.49 or below. Okay, that's option one. Or possibility number two, it's going to close at $41.50 or above. Okay, so only one of two outcomes are even possible. Okay, so in option one, let's just say the stock closes when the market closes Friday afternoon at 4:30. Let's just say that TQQ closes at $41 or $41.10 or $41.30. Okay. Maybe it closes at $39, but for whatever reason, it closes below this 41.50. Okay. If and when that happens, two things happen. Okay. Number one, which is really kind of great, I get to keep all of my stock. Okay. But even before that, the first thing that happens as soon as I say sell a call, I'm going to do two things here. I'm going to pick my strike price and my expiration date. In this case, I said, okay, I'm going to choose this strike price, $41.50. And I'm going to choose an expiration date of September 1st. That's when the option expires. Okay. This particular strike price, okay, on this particular expiration date pays 90 cents per share, or I should say, it's really, and I say per share because per contract, it's really this times 100. And now I'm going to pull up Fidelity Active Trader Pro, and here is the options chain. Okay, so here's TQQ. Here's the price of it right now. It's like $41.56. Of course, it changes like every second. Here's the option chains with all of your strike prices. Okay, all of your calls, the call prices, the menu, right, is over here on the left-hand side. All of your puts right here are on the left-hand side. So when you're selling covered calls, what you're really doing is selling a call. Okay. There's always two sides to the desk. There's the buyer and the seller. Most people are buying naked calls, which, in my opinion, you might have heard the statistic that something like 95% of new day traders or options traders go broke and you blow up their accounts. The reason for that is because 95% of the people that end up going broke and blowing up their accounts are usually buying naked calls or naked puts or doing some sort of combination. But most of the time it's because they are buyers and not sellers. The sellers are the ones that are making all the money. So right here, I chose this strike price. I chose $41.50, and I sold a call. Right now, that is 90 cents. And what I did is I actually brought up the chart on this. You can kind of see, and I actually got it right at 90 cents. So that's where it's at right this second. I just put in a limit order to buy it at this price just from looking at the chart. So let me pull up this chart. It's that's a fresh one. I've got one that's already got all my stuff on it. Let me find it here. Okay, here we go. So here's my chart. So here's the chart for TQQQ at the $41.50 strike price. And here's kind of this is just the 1 day chart. So it started off right around here at well, you can see the legend up here, the open and the high and the low and the close. That's the OHLC. Okay, so on any given bar, you can look at this. So it opened at 86 cents for the day, had a high of 87, a low of 84. And that particular bar right there closed at 86. So it's kind of a doji bar there, kind of closed in the middle. Then you've got your green bars. Price went up a little bit, had a high of 97, a low of 91. A few minutes later, came all the way down here, crashed a little bit, had a high of 85 cents, a low of 76 cents, which I was like, whoa. And then later on, I almost had a double bottom here. Not quite 76, but it went to 78 and 78 on the lows, almost came down to the bottom here. Then took off like a rocket, went all the way up here to like right at a little bit above $1.20, and then crashed again, came all the way down to 70 cents, and now we're back to 90 cents. So kind of looking at this, I was also looking at the volume for the day. I kind of thought that 90 was going to be a price that I could get where two things. I thought realistically I could hit that 90-cent price point, and I thought it wasn't going to be so high that it was not going to hit. Like you don't want to set that limit order price that you want to be like so high that you feel like you're not going to get there, especially since I broke down into the 70s here and then broke down into the 70s here. So I put in my limit order at 90 cents. Now, right after that, unfortunately for me, like it went all the way up here to like $1.20. Wish I could have locked into that price. I'll show you that that's about a $2,000 difference, $2,000 more that I would have gotten. So left some money on the table there, but that's part of trading. It happens. All right. So coming back here to the sheet, I bought the stock at $38 a share. Okay. Bought 7,600 shares, spent $289,000. Okay. The strike price that I sold, this is very important. Here's the strike price that I chose, $41.50. And here's the expiration date that I chose, September 1st. Okay. That means that, well, it means a couple things. The very first thing that happens, as soon as I say, okay, execute, make that trade, go ahead and do it. 41.50 is my strike price. September 1st is my expiration date. The second it hits $90, all of those orders execute. Okay. Here's the premium that I receive for each account. Now this is I just factor in all the fees and commissions that gets taken out. Okay. Here's the premium that I gray out. That's the raw number with no commissions taken out. So that's why like this one's $1,800, but after fees, which is the commission I pay like 35 cents a contract, comes out to $1,793. So this is what I actually collect. Okay. So, and I've totaled all of that right here. So the first thing that happens once I say, okay, this strike price, 41.50 with this expiration date, September 1st, as soon as that price hits 90 cents, I want you to go ahead and execute all of these orders for all of these accounts. They'll all execute simultaneously. It's one of the reasons that I set up limit orders so that I don't have to individually go into like 5 or 6 different accounts and go sell now, sell now, sell now, because it's that price is going to bounce all over the price. So I go in and I do limit orders for each of the accounts. That way, when the price hits, just bam, they all execute at the same time. Okay. So I said all of that to say, as soon as that order executes, bam. Okay. That is what I collect, $5,648. That is always the first thing that happens. That $5,600 is mine to keep forever. It doesn't matter what happens with the trade after that. This is the premium that I collect just for selling that call. So it doesn't matter if the stock finishes or the option finishes in the money or out of the money. It doesn't when the market closes on Friday at my expiration date. Makes absolutely no difference whatsoever. This $5,600 is what I got paid just for selling that option because I chose this strike price, 41.50, on this expiration date. It pays this much, 90 cents per share, and each option is 100 shares. So it's going to pay me this, the premium, minus the fees. This money is mine for each one of those accounts. I'm collecting $5,600 just for selling that option. Okay, so that's the first thing that happens on covered calls. I'm getting paid just for owning the stock, which is a beautiful, beautiful thing. Okay, now after this happens, this money is already in my account. I've already collected $5,648. Okay, now it's a waiting game. Okay, September. The only possible thing that can happen next is September 1st, which is coming up this Friday when the market closes. Only one of two things can happen. Okay. Either the stock is going to close at 41.49 or below, or option B, it's going to close at 41.50 or above. Okay. So I'm going to talk about both scenarios and say, well, Josh, which one is better for you? Which one works out the best? Which one do you prefer? The answer is it really doesn't matter because if you've been doing this for as many years as I have, sometimes you're going to get signed, sometimes you're not. Okay, just that's the nature of the game. Okay, so let's just talk about option one. Let's say the stock closes at 38, okay, or 39 or 40 or 41 or 41.20 or 41.48 cents, something like that. Okay. So if it closes, and I'm just picking out numbers around, but basically anything at $41.49 or lower than this number here, if it closes at any of these, okay, it's beautiful. Absolutely nothing happens. I get to keep this $5,600. I get to keep it regardless of what happens. Doesn't matter even if it goes above, but that 5,600 bucks is mine regardless. But if it closes at any of these prices, anywhere between anywhere below this, I also keep all of my shares of stock. So I still keep the 7,600 shares that I own. And then the market closes. I have a great weekend, and Monday comes, and I can do this all over again. Okay. That's option one. Option one is I get to keep all this money, the 5,600 bucks, and I get to keep all of my shares. Okay. Option two. Okay. Let's get rid of all these. Let's say the stock closes at $42 or 43 or 45 or $46, or and basically if it closes and even like here 41, I'll say $41.55, 42, 43, 44, 45, 46. Okay, let's say it closes at 41. The market closes Friday afternoon and TQQQ is at $41.55 when the market closes. Okay, again, two things happen. One, this $5,648 is still my money. That's already in my account from when I made the trade. I get to keep that regardless of what happens. Okay. Then the second thing that happens, because I chose this strike price, $41.50, that's my strike price here. Okay. When the market closes, if this stock is at $41.55, I am required, since I've got 75 contracts, that's 7,500 shares. I am obligated, I am required to sell all of those shares, all 7,500. I get to keep the other 127 shares, whatever it is, right? All the remainders. Like out of the 162, I have to sell 100 shares. I get to keep the 62 shares because that doesn't factor in. I get to keep the 10 shares here. I get to keep the 40 shares here. I get to keep the 15 shares here because none of that was a factor on any of the options. But I did sell 75 contracts, which equals 7,500 shares. Okay. So Friday afternoon, the market closes. TQQQ is at $41.55. I am obligated, I am required to sell all of those shares, all 7,500 shares. I have to sell all of them for $41.50 because that is the strike price that I chose. Now, the beauty of that is that, look, I remember I purchased this stock at $38 a share. The market closes at 41.55. Okay. I keep all of the profit between the 38 bucks and the 41.50. So I'm actually made, not only did I make $5,600 and collected that in premium just for doing this, but right there, the difference is $3.50 a share. Look at this, $3.50 a share times say equal this times the $7,500 shares that I have to sell. I'm not doing this right. Oh, times 100. Sorry, times 100, because each options contract is 100 shares. I'm like, that's not right. Okay, let's put a dollar sign on that. Make that a whole lot prettier. Okay, so the stock went up $3.50. Okay, since I'm required to sell all of my shares at $41.50 now, and I have 75 contracts, I'm required to sell all 7,500 shares. I made $5,648 in premium just for selling the call. On the appreciation of the stock, I made $26,250. So the two of these together, here's the total there. I make almost $32,000, $31,898. 26,000 of that is just on the appreciation of the stock. And then I get another 5,600 for collecting the premium on it. So here's the beauty of covered calls, and here's why people do it. If I just, let's say you don't do any options trading at all, right? Let's just say you say, I'm going to buy and sell stock, and that's my strategy. If you buy the shares of stock at $38 a piece and you sell it at $41.50, and you have this many shares, this is the money that you're going to make. You're still going to make that $26,250. And that's fantastic, especially since I've only had this for like 2 weeks. Making 13 grand a week just doing this. That's fantastic. But if you sell covered calls, not only do you get this, you get to collect premium on top of it. So as a percentage, that's I mean, that's huge. That's this plus another roughly 20% that you're getting on top of that. Okay. So that's the reason you do covered calls. That's why you use the wheel strategy. Okay. Now that's a huge win for me because I get $26,000 from the appreciation of the stock, plus I get 5,600 in premium. I'm clearing almost $32,000 on this one trade. Since it closed at $41.55, guess what? The person that is required to buy all my shares, and it's usually not one person, it might be like 100 different people, 1,000 different people, because all those contracts could be broken up between multiple buyers. One guy might have said, hey, I want to buy calls on TQQQ at 41.50, but I only want one contract. He happens to buy one of the 75 contracts that I've got. So just because I'm the seller of all these shares from all these different accounts, I'm one seller, but there could be one buyer, there could be 75 buyers. You're never going to know. Doesn't really matter anyway. But those people actually lost money on that transaction. Why? Well, because the strike price is 41.50. The closing price was 41.55. You say, well, Josh, they bought all of your shares at 41.50, right? Now that stock is 41.55. They made 5 cents by buying that stock. No, they did not. And why is that? Because they bought that stock for 41.50. It's worth 41.55, so it's up 5 cents. But since I collected 90 cents in the premium, guess what? They are the buyers. They pay. If I'm selling the call and I'm collecting 90 cents, someone else is buying that call. They are paying that 90 cents. So all of these buyers, whether there was one buyer or 75 buyers or whoever, I collected 5,600 bucks, which means all of those people are that person. If it was just one person, just to make the math easier, that person lost 5,600 bucks minus the 5 cents per share. So look at it this way. They bought all the stock for 41.50 because they were required to do so. It's now worth 5 cents more, but they had to spend 90 cents buying that call. So they actually lost 85 cents per share, which means they lost $85 per contract, 75 contracts. The 50, basically the $5,600 that I collected, they lost that 5,600 bucks. So the stock is up 5 cents, but they bought that call. So when they bought it, their price was, hey, it's 90 cents or 90 bucks basically to buy this call. You only realized 5 cents in profit. They lost $85 for every contract that they bought. So I came out a real winner on this one. Now let's take another scenario. Same thing here. Let's say the stock Friday afternoon closes at $42. Okay. Again, I still make $26,250 because I get to keep all of the profit between $38 and $41.50 because I agreed to sell it at $41.50. I'm just locking in this profit here. I'm locking in this gain. Someone else is required to buy all of those shares at 42. Let's just say if Friday afternoon, if the market closes and TQQQ closes at $42 a share, they are required to buy it at $42 a share. I'm sorry, they're required to buy it at $41.50 because that's my strike price. It's now worth 42. They make 50 cents a share, but not really. They make 50 cents a share minus 90 cents a share. They still lose 40 cents for every share that they've got. And that's 7,500 shares. They're still losing money on this. They have to get all the way to basically 41.50 plus 90. That stock would have to close at $42.40 just for them to break even. So if this is 42.40, okay, they're required to buy all of my shares at 41.50. Say Friday afternoon, the stock closes at $42.40. There's a 90-cent difference there. Their stock is up 90 cents from where they're required to buy it from me, but they also spent 90 cents buying that call. So this is their break-even point right here, okay? That's why on my spreadsheet, I put That is my break-even point right here. Since I'm selling the option here at 41.50 and I'm getting paid 90 cents to do it, I as far as appreciation of stock before I'm actually, it's not losing money, it's just leaving money on the table. Anything above $42.40, anything above that number, then the buyer starts to make money. Okay. This is their break even point. This is where, but for me, this is not where I lose money. This is where I leave more and more money on the table. So let's just take an extreme example. Okay. Get rid of all these. And let's say it closes at, by some miracle, like right now it's $41.70. Okay. Let's say by Friday afternoon, it goes all the way to $46. Okay. So we'll do this with it. $46 minus, actually, it's really minus this, minus that, 42.40. Okay. Now they're making money because minus that, this is inclusive of their 90-cent cost. If you are the buyer of that call, you bought these calls for 90 cents for a 41.50 strike price. Now the stock Friday afternoon closes at $46 a share. Again, I still make the same amount of money. I bought it at 38. I'm required to sell it at $41.50. I still make $26,250 plus I collect this premium. I'm still making almost $32,000 on the transaction regardless. What I don't lose money, but what I miss out on is all of the gain between this 41.50 and $46. Okay. All of this gain right here, and everything between 41.50 and let's just say the market closes Friday at $46 a share, this person makes $3.60 a share. Now they get their 90 cents back. This is actually the profit. This is the money that I left on the table. Okay. That $3.60 additional. Okay. So if you take this $3.60 additional times 75 contracts times 100 shares, I would have made $26,250 on the appreciation, $5,600 on the premium, but I would have missed out on an additional $27,000. Now, all of the prices change because as soon as I say I don't want the 41.50 strike price, I want the $46 strike price. Look at this. The $46 strike price right now only pays me 2 cents instead of paying me. Well, right now it's at a dollar three, but it was 90 cents just a few minutes ago. Instead of paying me 90 cents, if I'd have chosen the $46 strike price, it only pays me 2 cents. So that's like way, way, way out of money. And look at the delta on this. It's like 0.03. So that's basically saying there's a 97% chance that this is going to finish in the money. For those of you that don't understand the Greeks or don't know what delta is, this column here, it's not automatically in the options chain, but you can basically pick and choose all the Greeks or all the different columns that you want in any given option chain. Delta, in very overly simplified terms, the delta is one of the Greeks. It basically tells you what is the percentage chance that the stock is going to hit this strike price at expiration. So on this 41.50 here, there is a 57% chance that when the market closes on September 1st, this option change right now is saying that there is of course, it changes every second or every minute, right? Now there's a 58% chance that this stock is going to close at or above $41.50. Okay. So if you were to sell covered calls, for example, at $36.50, the option chain is saying on September 1st, because your TQQQ right here is $41.90 currently, there is a 97% chance that the stock is going to finish at or above $36.50. Okay. Likewise, come down to the other extreme. The stock is at $41.90. Here's a strike price of $46. The delta is 0.3. They're saying that there is a 3% chance that this stock is going to close at or above $46. So when I sell covered calls, I usually like to pick something in the money. but something that is also above the price where I bought the stock. So again, I'll come back to this. I bought the stock at $38. I'm very comfortable selling covered calls at $41.50. Okay. Now, what does this mean? Okay. Let's just say, for the sake of argument, what's a realistic price? Let's say let's round up and say it's 41.88. Let's just say it closes at $42. Okay. Get rid of this. Okay. Let's just say Friday, the stock closes at $42. Okay. I'm required to sell all of my shares at $41.50. Okay. Equal $41.50 times 75 contracts times 100 shares. Okay. That means I get $311,250 for selling all those stocks. Remember, it only cost me what, 289,000, right? When I'm required to sell all 75 contracts, all 7,500 shares at this price, this is what it's going to pay me. So I'm going to get this 311 plus the 26 plus the 56. Click all these. Okay. So I'm going to end up with $343,000. So that next week, when I do this, my buying power now is not 289,000. My buying power is the 5,600 plus the 311 plus the 26,000. Okay. I get all of that 343,000. Now I've made some serious money. And now this number is going to go up. Instead of having all these shares, I'm going to use all that money to buy more shares of stock. And since I can buy, if I can, like, let's just say, for example, I can buy another 100 shares, right? So if this is 2,000, I can go 2,100 shares. Then I could buy 21 contracts instead of 20, right? So every time this goes up by 100, that also goes up. So here I've got 162 shares. If I can purchase just 38 more shares, go up to 200, then I can sell 2 contracts over here. I thought I did that on all these. Yeah. That's around down. Okay. So I did this so that if I buy, let's say I've got 7,800 shares here, I can sell 78 contracts, or 78.59, even if it's a weird number, I can sell 78 contracts. So I've written the formula over here in Excel to say, basically take this number and round down to the nearest 100. That's what this formula is here. So in a nutshell, that is the wheel strategy. It's the covered call. Now, why is it called the wheel strategy? Because I told you about 2 different scenarios. One, here's my strike price. Option 1, let's say the stock closes at $41.48, right? Okay, then I keep all my shares. I get this $5,600. I get the appreciated, not this number. I get this appreciation of the stock, but I own all the stock, so that's going to fluctuate, right? So as soon as the price of the stock fluctuates, so is my profit. But let's just say it closes at this $41.48. So it closes below that 41.50. Market closes, Friday is done. I have a great weekend. Now Monday comes. What's going to happen? Well, when Monday comes, I'm going to use this money plus this money, and I'm going to go out and I'm going to buy more shares of stock. It's going to increase this number here. Hopefully it'll increase the number of contracts that I'm able to sell. And Monday it starts all over. So just for the sake of example, I'm going to go to all these numbers, of course, will change and be different. I'm going to go to September 8th, because let's look at a calendar. Today is the 30th, right? My options expire September 1st. If it closes below 41.50, I get to keep all my shares plus all the money plus all the appreciation. September 4th comes. Okay, it's a Monday morning. I can do the exact same thing. I can do this wheel strategy again. I can sell covered calls again on Monday or Tuesday, and for me, I just do weekly options. So I'm gonna pick a September 8th expiration date. I'm going to do the same thing this week, September 4th, that I did right here. Now here I didn't buy until I didn't opt to sell those calls only because I didn't like the prices. It just wasn't. I thought the price might go up, and so the price was a little bit lower. And you can look at that and you can tell on the 4150 here. Oh, it's over here. So here's my chart. This is the 1 day chart and just kind of go up, and then it crashed, and then it came back up, and then it went back down. And right here, we're right back where I picked initially. That green bar, boom, 90 cents is like smack dab in the middle of it right at this second. Okay. But this is the 1 minute chart for today. Well, let's say I went back like 5 days. Okay. Look at where these prices were. Okay. That's why I waited until I could sell covered calls, because before it was only paying me like 20 cents, and I was like, nah, it's like, yes, I can make some money, but it's not really worth it. It's only the first of the week. I'm gonna hold out and just kind of wait and see what the price does. I could choose a different strike price, but really I like to make a little bit more. So yesterday the market was up. That was very, very good. Market had a very, very good day yesterday, and I was like, okay, so Wednesday, that's going to be my day, and that's kind of I don't know where the day was, but I'll go back to the today. The one day kind of opened up in this range, right around 90 cents. Went up, went down. That's a five. Those are 5 minute candles. Go to the 1 minute candles. But it was right. It was right around 85 cents, came up to 90, and then kind of went up and down. That's why I chose that $90 strike price, $90 price on the 4150. Kind of went up and down, but that's what I ended up getting. Now, as this, because of theta and because of one of the Greeks and because of time decay, I suspect that this number will go down and down and down until, if the price of TQQQ, let's just say, closes at like $41.20 or whatever, this number, it's not going to pay 90 cents a contract. It's going to go all the way to zero. The closer you get to the expiration and the further you are away from that strike price number, theta decays over time. So the value of this is going to decay. So the reason I opted to sell the options in the first place, look at this 5 day history, is because what I would have gotten paid if I sold covered calls all down here was like less than 20 cents, just abysmal. I'm like, I'm not doing that. But as soon as the stock appreciated in value, I'm like, okay, now it's already appreciated in value. I've already made money on the stock. Now I'm going to sell covered calls at that higher price for a really nice premium. Went all the way to $1.20, unfortunately, which is, again, left some money on the table there, about $3,000. But anyway, I'm okay with it because it's kind of floating here and consolidating. I mean, it's bounced up and down, but really the middle line here is right around. I'm going to say it's really right around 95 cents. Is kind of the median price there. But as we get closer to Friday, it's only Wednesday morning, but so by afternoon, I anticipate this will drop. By Thursday, it's going to drop more, and by Friday, it's just going to like fall off. Friday it's going to look like this. Friday it's going to just fall off a cliff. It's right at 90 cents here, and this is what I anticipate Friday is going to look like. It's just going to fall, and go all the way to zero. Okay, that's if the stock closes at $41.49 or below. But as I said, even if it closes at $42, I'm like, hey, even if it closes at $42.40, I'm like, hey, I'm okay. I got paid $5,600 for the premium, and had required to sell all my shares at 41.50. Again, if I'm required to sell all of these shares here at 41.50 times 100 times the 75 contracts, I'm still making $311,000 plus the $5,000, and then I can use that to buy more stock. So in a nutshell, that's the wheel strategy. Now, what happens Monday morning? Of course, it's going to sell all those shares. Now I don't own the stock at all, right? Because I'm just required to sell all those shares. But Monday, if it closes at $42, I'm just going to buy it at $42. Okay. Whatever the price is Monday, if I'm required to sell all my shares, I'm just going to buy it. Sometimes I might wait for a dip, but usually I'm just going to get, because of the wheel strategy, it's kind of a cycle, just kind of spins and goes round and round. If it closed at $42 Friday, and just say it opens at $42 Monday, I'm going to buy it at $42, and I'm probably going to sell covered calls at, like, depending on what the price is, probably like, I don't know, 44, 45, 46, something like that. Because my cost is at 42. I'm going to sell covered calls depending on what the market does and if I can get a decent price. I'm going to sell covered calls at 42. I'm sorry, I'm going to sell covered calls at 44 or 45 at 46, because this is now my new cost basis. Okay. So I'm going to sell covered calls somewhere above that, depending on what the options chain pays me. Okay. So I'm going to come back to this, okay, this is what it looks like right now. This is not what it's going to look like next week, because right now the 41.50 is paying with a September 8th expiration date is paying $1.48. Like, that's awesome. Okay. I'd be almost gosh, that times 7,500. Like, that's what I would get paid. That's incredible. I'd be ecstatic. But you have to wait another week. So, and the reason I do weeklies is because typically when you compare like, this is paying $1 to 41.50 expiring 2 days from now, whereas September 8th it's paying $1.48. It's paying for an additional 1 week. Okay, it's only paying you an additional 40 something cents, almost 50 cents. So why would I do that when I can get $1 for the week and I only get an extra 46 cents for the second week? I'd rather just do this weekly, let it expire, and then when these numbers change and I look at them next week, it might be right around $1. So if I can get $1 here and $1 here, or in my case, maybe 90 cents here and 90 cents here, that's $1.80. Why would I, it makes more sense to do that than taking another week and getting this $1.48. So this is more in that 1 week period, getting it up front, but it's not more money in the long run. In the long run. So this is why I do the wheel strategy, and I do typically do a 1 week or basically a 5 day expiration. In this case, it's only a 2 day expiration. I actually bought, I bought all the stock like a couple weeks, like 2 weeks ago, and I've sold covered calls since then. Last week, I only made, I'm trying to remember off the top of my head, like 2 weeks ago, I did it. I bought it at 38 and it closed at, I sold covered calls at like 40 and it closed at like 39 something. But that $40 strike price that I chose, I want to say last week I made like, the first week I only made like $1,200, and then the second week I made like $3,600. So I already made like 4,800 so far, and then I already made 5,600 this is my third week of doing it. So just on the premium collected, remember, I only paid $38 a share for the stock, but first week I got about $1,200 worth of premium. Not very much, just the option chains and what it was paying just wasn't very good. So the first week I made $1,200 just in premium. The second week I made about $3,600 in premium, so I was pretty happy with that. And this week I'm making $5,600 in premium. And again, I've gotten to keep all my shares. Plus, I'm realizing right now, since I bought it at 38, it's almost at 42. That's almost $4 a share. Now I did a 41.50 strike, so the most I can make is $3.50 per share. But remember, on top of that, even though that equals, come back here, that for $38 a share, if I'm required to sell at 41.50, that's what's going to be in all my accounts combined. I get $311,000. Plus, remember, week one I made $1,200. Week two I made $3,600. Week three I made $5,600. So if I add all that up, just 56.48, and then last week it was like 3,600, and the week before that it was 1,200. Equals sum. Okay, just on the premium collected. Okay, just on the premium, has nothing to do with the share price or appreciation at all. Just on the premium, I'm making over $10,000. Okay, and then on the share appreciation, I'm making $26,000. So I'm going to make if you just own the stock, you'd only make 26,000. But if you sell covered calls and collect premium, you still get the same amount on the share appreciation, plus an additional $10,000. So again, that's why they call it the wheel strategy, because one of two things happen. In the first scenario, the stock closes below your strike price. You get to keep all your shares, plus you get to keep the premium. And then next Monday when the market opens, I do the exact same thing, and I just keep doing it and doing it and doing it. Okay. Option two is, let's say the stock closes at $42 Friday afternoon. I'm required to sell all of my shares at $41.50. I missed out on a 50-cent gain, but really, since I got paid 90 cents per share here, my break even is actually 42.40. If it closes at $42, I didn't leave any money at all on the table. I actually made more money. So come Monday morning, I'm going to buy it all back. I don't own any of the stock at all, right? Because I'm required to sell it all at 41.50. So now I don't own it at all. I've just got $311,000 sitting in these accounts. It's all sitting in cash. Now I have to go out and I have to buy all this stock at 42 bucks. And when I do that, I'm going to sell covered calls. Either I'm going to check the option chain, but probably like 44 or 45 or 46 in a 1 week time span. So this week, looking at the options chain, September 1st, let's just say that I had to buy it again at 42 bucks. Okay. If I wanted to sell it at 42 bucks and choose the same strike price as where I bought it, if it opened to close, basically when Friday comes, it closed at the same price. I could sell this for 72 cents because it just changed on me per share. I'd make 72 cents per share. I bought it at 42. I'd be required to sell it at 42 if it closes at that, but I still make 72 cents a share on top of that. I probably wouldn't do that. If I bought it at 42, I'd probably be looking at like 44, be like, oh, that's only 16 cents. I don't really like that. I'm going to go a week out. Let's go to 44. This is 48 cents. That's a little bit better. And then I'm just going to evaluate kind of the prices. What if I do 50 more cents on the strike price? Takes about 14 cents off the price. That's as a percentage, 14 cents. That's a huge hit from the 48 cents for just a 50-cent difference. But these are the kinds of things that I look at and I evaluate. But for this week, I wanted to share this webinar and share it with you guys just to let you know what I did. I bought the shares at $38 a share. I bought all these shares at $38 a share 3 weeks ago. The first week I collected premium, sold covered calls. I made $1,200. Last week I did the same thing. I made $3,600. This week's I did the exact same thing. Made $5,600. And the reason I made $5,600 is because I chose this strike price at this expiration date, and I got paid 90 cents per share for doing that. So on each of these accounts, you total them all up. That's when I get paid. What I'm really hoping is maybe the stock closes at $41.48. That'd be beautiful. I get to keep all my shares. And then Monday morning comes. This is what just for the sake of argument, I'm going to say, okay, it closes it Friday at 41.48. It's going to open Monday at 41.48, which is not going to happen because usually your closing pricing for one day and your opening price the next day are almost never the same. They're usually different by a few cents, but just to make the math easy and say, hey, I still own all my shares. They're worth $41.48. I'm going to start looking at a September 8th expiration date, right? Because looking at the calendar here, I got paid. I sold all these on the 30th. Market closed September 1, below my strike price. I get to keep all my shares. Market opens September 4th. Stock price is, let's just say it's $41 and, well, not 80 cents, because that means now I don't own anything and I would have had to sell all my shares. But it doesn't matter if it's Monday morning right now, I had to sell all my shares, okay? And now the price is 41.80. I'm going to buy as many shares as I possibly can at 41.80. And then I'm going to come in here and say, all right, 41.80, what am I happy with? I'm going to start selling covered calls maybe I look at like 45. That's going to pay me 25 cents per contract. Okay. So I come over here and I look at my little calculator and say, okay, this particular week, I'm not going to get 90 cents. I'm only going to get 25 cents. Okay. And that's going to pay me $1,575. Okay. So that's why you see like the week one, I only made 1,200, but the price of the stock kept going up. So the premiums got juicier and juicier at the higher prices. So that's why I got 3,600 last week and 5,600 this week. Next week, that most likely will not be the case. So if it closes at this 41.48, I'm probably going to look at like 44. So I'd only get like 47 cents. So I come in here and I go, all right, so I'm going to get 0.47 cents at the let's say, what did I say, the $44 price. Okay, so your break even there is the $44 strike plus the 47 cents that you're getting paid. Your break even is 44.47, and that is going to pay me 29.61. So next week, if that's the case, I'm just kind of showing a hypothetical example here for next week, potentially, possibly. Again, if I can, if Monday the stock opens at, let's just say 41.48, I'm going to sell covered calls at 44. Right now, that price is 47 cents. Okay. The strike price of $44 pays me 47 cents. This will be September 8th instead of September 1st. that's going to pay me 2,900 bucks. Okay. And I just rinse and repeat over and over and over. And I do this every single week. And if the stock closes below my strike price, I get to keep all my shares. And then I just choose a new strike price the following week. That's option one. Option two is the stock closes above my strike price. I get to keep all the profit. This, I have to sell all my stock. I get this amount of cash in my account, and however much money that is, I just go out and I buy more stock, however many shares I can buy in each account. And I divvy it up with that amount of money, makes me able to sell this many contracts, probably more, because I can buy, if I can buy more shares, means I can buy more, sell more contracts. All of these numbers are going to adjust, and you just rinse and repeat that over and over. And that's why I think that the wheel strategy and the covered call strategy is the not only a very conservative strategy, but you can make money just for owning the stock. So hope you guys learned something from this. If I'm gonna go ahead and post this on the Facebook page here with the link and the recording. If you guys enjoyed it, feel free to leave a comment. I'm going to try to do this. I try to do it about once a week. It doesn't always happen because sometimes I'm busy doing other things. But anyway, hope you guys learned something here. God bless you guys and have a great day.